again, non-farm payrolls coming in below expectations. Last month's getting revised lower as well, but we're going to dive a bit deeper into this because the unemployment rate also at 3.6, down from 3.7. Participation rate, it looks like, coming in a little bit higher than expectations here. So again, lots to break down here in terms of, actually, it looks like participation at 62.6 in line, but that non-farm payrolls, ladies and gentlemen, at 209,000, well below expectations. And well, here you can see the initial reaction too. There was a lot of uncertainty heading into this number after the stronger than expected ADP jobs report earlier this week. And well, it seems like markets are pretty happy with the initial look at, again, non-farm payrolls here in the U.S. for the month of June coming in at 209,000 below expectations for 225. And as mentioned, I think that revision to last month's, what was that, 339 down to 306 is probably aiding the run up here as well. Let's bring in Scott Bauer, CEO of Prosper Trading Academy, joining us this morning. He's in the hot seat. Scott, you've had a few seconds, I guess I should say, to look at the number, but based on the indices, the reaction we're seeing too, it seems like investors and traders are pretty happy with this one.
Well, I think after yesterday's ADP number, anything around expectation today would be a welcome relief for the market.
Sigh of relief.
Exactly. The fact that it's lower and the fact that we're revising May lower, to me, is a real positive for this market. And you know, I hate to say it, Ben, because we're in this bad news is good news is bad news sort of, you know, situation right now. The market should be rallying bigger on this. And I would expect as the day progresses here, we're going to fight that 44.50. We're going to get back some of those losses that we've seen over the last couple of weeks. The one fly in the ointment, as you said here, the wages number, that did tick up. And that is something that, you know, the Fed is going to watch so closely, probably more so than what the actual number was, the 209 number. But I think all in all, especially given the week we've had, the ADP number yesterday, this is something that the market can kind of look at and say, breathe a little sigh of relief here.
Yeah, I think it is at this point. At least still, we're seeing it as a win for the bulls in many instances, and we have yet to really reverse at this point. Again, the gains, I should argue, are somewhat limited. We'll see if we can add to them. But let's dive a little bit deeper into that wages component, because that's where the real concern comes into play, right? Yep. Tight labor markets, very strong conditions in terms of employment here in the U.S., sparking or reigniting thoughts that at some point we're going to have to see more incentive, more lure to get people in, and that comes from wages, that comes from bonuses, right, for example, and an uptick here, higher than expected, 0.3 is what they were looking for. The average hourly earnings came in up 0.4%, and it does look like, again, as much as the last non-farm payrolls number was revised lower, this one got revised ever so slightly up from 0.3 to 0.4, so that could kind of balance out some of that easing or that pause or that sigh of release that you were talking about.
Yeah, absolutely here. And you know, when we see that uptick in wages there, that actually correlates directly to how strong the consumer has been. So even though, you know, inflation is still there, prices are going up, wages also going up, albeit not as much as inflation has. But to me, that's what's underlying the strong consumer here and why we continue to get very, very strong data about consumer spending, some retail sales figures. And you know, that is a good thing. It's not a good thing for the market per se in terms of the Fed. That is a good thing. We want to see a robust economy. But, you know, this is a number that probably makes the Fed say, all right, no different than we were just a few days ago. We're still on track. We're going to raise a quarter, you know, at the next meeting. I haven't seen the CME FedWatch tool yet to see what's going on the further end in November, because as of yesterday, there was a 50% probability of some hike in November. I haven't seen what that is yet.
We'll take a look at that in a second here. Scott, I'm noticing manufacturing payrolls coming in at 7,000. They were looking for them to come in flat, and they actually did revise last month's down a little bit more, down 3,000. But let's talk a little bit further about the Fed here ultimately. I mean, now that they have this data point here on their desk, right, and more information, which is what they're waiting for, they can look a little bit further out in terms of some of the inflation data due out next week. We've got, again, the focal points as far as this inflation narrative just continue to keep coming.
Absolutely. And For all of the Fed bashing that has been going on, and I'm not a big proponent, let's say, but for all the Fed bashing, I think what this does, this situation yesterday, today, is it absolutely sets them up for the quarter point hike in a couple weeks. The market has accepted that already, but then it's what happens beyond that. But it seems like we've been in this story for a year, Ben, right?
Yeah.
Right? We know what's going to happen in a couple weeks, but what's going to happen down the road a little bit here. So, that terminal rate probably has ticked up just a little bit, but so far, every time we've seen that, the market has been unbelievably resilient.
But, some of the resilience, I'd argue, Scott, correct me if I'm wrong, has come from the fact that Fed Chair Jerome Powell, to his credit, has telegraphed and projected much of where we are very well, right, in terms of his verbiage, his terminology, his persistence in terms of the message. And I guess one could argue what we're seeing here is more the shift in terms of markets trying to come to grips with what Powell has been saying for a long time. To your point, he's also been saying, look, we're data dependent. We're going to continue to be.
Absolutely. And that's why I said that the markets are, really resilient, because if I really look at what he has said, especially recently, right, over the last several weeks, there's no question that he and the rest of the Fed have absolutely leaned towards the hawkish side here. And yet, we're fighting to get back to those highs that we saw, up at the 4,600 level, right? We're only 4,450. That's a big hurdle to get through. If we get through that, though, Ben, this market, it can really fly to 4,600 in the face of all of this, let's call it, negativity on the jobs market.
Absolutely. A lot of naysayers out there, and we are seeing a shift in sentiment tied to stronger labor conditions here in the U.S., or resiliently strong labor conditions here in the U.S. And Scott, correct me if I'm wrong, but a lot of focus on the big seven, right? These individual names that have sparked this rally. But if labor conditions remain very strong, if we don't see a spike in inflation right now, in theory, that pushes back some of those recession fears. And this rally could get a little bit more broad-based if that starts to play out.
No question about it. And that's what the market really needs, because I think you're starting to see those big seven calm down a little bit, right?
Definitely.
We're not seeing the volatility. We're not seeing the big moves in the big seven. So it's allowing time for, the rest of the market to catch up just a little bit. And you're absolutely right. I mean, we can, put aside or alleviate some of these inflation concerns. And really, to me, again, if we can sustain through 4,450, Ben, 4,600 to me is that next number.
Hearing a lot of concern about mortgage rates on the rise ultimately, and the constraint that puts on some of the potential buyers out there, the economy in general. Talk to us real quick about, Scott, the run-up we've seen this week in yields, right? I mean, in reaction to the ADP, I've got the 10-year, which is inching off a bit here now, still holding above 4%. The 2-year still right at 4.8 as we speak. So we're off the highs that we saw this week, but not by much. I mean, this is something to keep a close eye on. I've been arguing for a while it's a matter of when, not if, higher rates are going to present a headwind for stocks. We've shrugged it off for a while now, but with this recent spike, and if it continues, one could argue that that's going to be a thing of the past.
It is a matter of when. You're right. I mean, somewhere down the road, this is going to have to come home to roost unless we start seeing rates, really start coming down. But in terms of mortgage rates, Ben, this is crazy where we are now compared to where we were 18 months ago, or even a year ago. But what I'm hearing is the reason that the housing market is just hanging in there and staying so strong is because there's a lack of inventory out there. So people that are out there in the market, regardless of the price level of the homes they're looking at, whether you're in the $300,000 to $400,000 range, the $700,000 to $800,000, or even above, a lot of people are still paying cash. So the mortgage rates being at 6.5%, almost 7% now, have not impacted this housing market as much as you would think that they have.
Scott, a final thought, less than 30 seconds on this jobs report here, coming in lower than expected this morning. What to watch for today in reaction to?
I would watch for a big spike up later in the day. I really would. Unless some more content comes out, some more context about some of the details in this number here with the wage number here. I think we're going to see a big sigh of relief here, and going into the weekend, I think we could see a big pop to the upside. Look
at this, NASDAQ off the charts as we speak here. Scott Bauer, appreciate you joining us, CEO of Prosper Trading Academy.